last week, with the weakness in the equities market and the bond market, I was asked to comment on the Aussie dollar. The way we look at the Aussie dollar, and we show them in the quarterly, is we show firstly a model of commodities, and that is a model of the Reserve Bank of Australia Index of Commodity Prices, which is updated at the beginning of every month on the RBA website. So we have a model of that, and then we put that in the second part into our model of the Aussie dollar, together with interest rates and other factors. So I'll go through those as they appear in the quarterly and will appear in the next quarterly. And in addition to that, because of the continuing interest in the market, I'll mention our updated fair values of both the S&P 500 and the ASX 200, given that the correction in equities has been continuing this week. Commodity prices. Back in May 2020, when I think oil had fallen to, and other commodities had fallen very, very sharply, I made the outrageous comment that I thought that we were facing, and we would soon be entering a commodity boom, which was even bigger than the resources boom that we'd had in 2011 after the financial crisis. And the reason I made that outrageous comment was what was happening in the expansion of the US budget deficit. I'd learned in analysing the resources boom earlier this century, it was the expansion of the US budget deficit in response to the financial crisis, which when I modelled the effects, that was the thing that caused the increase in demand, which generated the higher prices associated with the resources boom. Now, back then, the budget deficit had reached a level, the US budget deficit had reached a level of about 11% of GDP. This time around in 2020, the budget deficit looked like getting to an even larger number, and in fact it got to, in 2020, 16% of GDP, and that was followed in 2021 by a budget deficit of 21% of GDP. And as I forecast, that generated a commodities boom, which in terms of the peak prices was higher than the previous resources boom because the stimulus was greater. When I looked at the relationship between those price movements and that expansion of US fiscal spending, I found that the lag was just under 2 years, around about 21 months. So that meant that you could quite reasonably predict something that was happening almost 2 years in front. But now what we're living through is the results of those budget deficits peaking back in 2020 and with the second budget deficit in 2021, and the US budget deficit now falling back to a level of about 5% last year, but now 6% this year and every year going forward. And so what that means is we're looking at the effect on prices of a 10% decline in the US budget deficit. And what we can see now, and what was forecast in the model and what's actually happened, is that Australian export commodity prices, as measured by the RBA index, peaked in about March this year. And they peaked, currently the RBA index rebalances itself or re-indexes itself based on the recent period. It's currently based on the number 100 as the average of 21 and 22 export prices. And so now what happened was that in March this year, the RBA index of commodity export prices peaked about 120% of the base level. And since that time, it's fallen to about 90% of that base level. which means it's just now fallen below the peak levels of the previous resources boom. But what the model shows is that just as budget deficits continue to fall from that period of 21, 22 to now, commodity prices will continue to fall, and they will continue, and they will reach a low at about 70 on this scale, or about 20% below, where we're currently about 90, and they'll fall to about 70 by about March next year. So commodity prices will continue to weaken in terms of this model as this effect of the US budget deficit recedes, and it'll continue to fall until March, where it will bottom out and gradually start to rise as the effect of the modest increases of the budget deficit from 5.8 to 6.3 and that kind of stuff associated with the big spending programs like the amazingly called Inflation Reduction Act and the CHIPS Act, which have generated an underlying budget deficit in the US about 6.4% of GDP. So what's been happening in recent periods is that the Aussie dollar has been falling in line with commodity prices at a level about a standard error lower in terms of the model than those commodity prices. That is to say, traders in the Aussie dollar have been anticipating continuing falls in commodity prices correctly, anticipating falls in commodity prices, and have been pricing the Aussie dollar about a standard error below that value. Currently, fair value in the model is 70 cents. Based on, this is data going back to the beginning of the century. We have data on both the $8 US dollar exchange rate. We've adjusted them for the CPIs in the different countries. We've added the relative interest rates in the different countries. We've added the liquidity in the US wholesale market to give us a measure of liquidity in the market, and that explains just under 80%, about 76% of monthly variation in the commodity prices. So that's what's happening now, is it's continuing to fall. Now, I would think that will continue to be weak until commodity prices bottom out in about March next year. So if you're looking, or if you have clients who would think it's time for them to get in the Aussie dollar, well, you can, well, it's a standard error cheaper where the model is now. It's not it's almost a standard error cheaper than the model is now, but I think it'll be cheaper by the time you get into March. So I would say the correct answer to that question is yes, you can get into the Aussie dollar, but not yet. Wait until early next year. A brief comment on the market. We are in the normal period when both the S&P 500 and the ASX 200 correct, which is in the August-September period. The reason that stock market's correct in the August-September period is that this is the end of the US government financial year, when corporates pay their taxes, and that takes liquidity out of the market and tends to drive it down to fair value or a touch below. This process is going to go on, I think, until the end of September, as it usually does, followed by a rally in the final quarter, as it usually is. Right now, or as of yesterday, my fair value for the S&P 500 still suggests room to correct. My fair value is 4,082 points. The model explains just under 90% of monthly variation of the S&P 500, 4,082 points. And the Aussie dollar is fair value is 7,037 points, 7,040 points. So the Aussie dollar is closer, the ASX 200, 7,037 points. The Aussie market is closer to fair value, but I think it will continue to correct as long as the S&P 500 corrects. So these are markets where there's plenty of price action, but right now there's more action still to come.